Good evening, everyone. This is Viraj Popat and Harsh Bondi. This is the very first video of our channel as well as our company. We couldn't find a day better than the budget day. We are here to discuss some major amendments made by our Honorable Finance Minister Nirmala Sitharaman. My friend Harsh will continue from here.
So we'll directly come on to the amendments made in income tax, where we find a significant relief has been given for expenses related to COVID-19. Here in section 17, which deals with perquisites, we clearly see that the government has given exemption, and these perquisites where you have received from your employer any payment related to illness causing because of COVID-19, you'll get an exemption under section 17. Correspondingly, amendments has been made in section 56. Amendments have been made in section 56(10), wherein wherever an individual is getting any money from his relatives, or he's getting it from his employer, or he's getting from any unrelated person, we find that exemption of up to 10 lakh rupees, as the same is available on your systems as well, and is available to them, right? And this should be, there is an important clause added here that the money received in this case should be where the person died due to COVID, and it should be within 12 months. The money should have been received within 12 months. No other conditions as of now has been provided by the government here. Second major thing that everyone expected was from the finance minister that certainty could have been brought with about taxation on cryptocurrencies, NFTs, and other related assets which are electronic assets. And we see here through new sections have been brought in the act, that is 115 BBH, where total income of the SSE will be taxable at the rate of 30% if it is accruing out of virtual digital assets, which includes every kind of asset, may it be NFT or any crypto, non-crypto, and even the government may exclude some things, but till now there have been no exemption provided by the government. And there will be no set-off allowed against there will be no set-off of losses allowed in case it is coming from virtual digital assets, nor there is any carry forward given here. Also, we find that no deduction in respect of any expenditure, be it any consultancy or any brokerage that you may have given for your transfers or anything. You will not find any deductions here. After this, we find a significant amendment in section 79A, where if there is a search and survey and some undisclosed income is identified by the department, in that case, that undisclosed income will not be allowed to set off against any losses that has been carried forward from before that year or during the year, right? So this is a very big amendment for all the assessments that are pending. Thereafter, we come to section 194S, which is specifically provided here so that people selling these assets, virtual assets, can be brought into taxation. And as we see on the screen, any person responsible for paying to resident any sum by way of consideration for transfer of a virtual asset shall at the time of credit of such sum to the account of resident, or at the time of payment of such sum by any mode, whichever earlier, deduct an amount equal to 1% of such sum. So here we are pretty sure and that 1% TDS will be deducted. Now coming straight away to the points that 203A and 206AB shall not apply, which here is that even if you do not have a PAN, you have to deduct TDS. And also 206AB, which deals with twice the rate, which is a kind of penalty section in case where the person who has sold you the asset. If he has filed or not filed the return, that will not be a concern for anybody, because 206 AB has been specifically excluded from here. Now we come to applicability and people who have been exempted from it. So we find two things here. One is a consideration is payable by a specified person and the aggregate value does not exceed 50,000, right? So as we see here in point 3a, the consideration is payable by a specified person and the value or aggregate value of such consideration does not exceed 50,000 rupees during the financial year. And the second type of people will be those people which is other than specified person, and the consideration will not exceed 10,000 rupees during the financial year, as we see in point number B. Now, to understand, we have to go down a little bit. We see the explanation has been provided for specified person, wherein an individual on HUF whose total sales, gross receipts or turnover from business carried on by him does not exceed 1 crore. So it is specified people are those people on whose turnover is not exceeding 1 crore. There is no such clause that tax audit should be applicable or not. It only says about 1 crore. So even if you are having a turnover of, say, suppose 9 crores and you are not getting tax audited, but still this section will apply to you as an individual, as a specified person, right? And specified person also includes specified person also includes all those people who does not have any PGPP. So every salaried people, every people having other source income, it covers everyone. So every person is a specified person, right? And now if we go back to the above clauses, we see a consideration is payable by any person other than a specified person. So those people whose turnover is more than 1 crore, those people who have more than 1 crore will have to get will attract TDS if the aggregate amount is exceeding 10,000. Otherwise, if your turnover is less than 1 crore or you have income under other sources, say it be salary, house property or anything, then the limit will be 50,000. That is all related to the major highlights, we would say. There are some more points which Viraj will be discussing with you. Viraj, you can take over now.
The government has come up with an amazing amendment here. A concept of updated return has been introduced. What is this updated return? Say we have filed your returns for financial year 1920, that is assessment year 2021. But there was one transaction which your consultant or you may have missed, which is taxable, obviously. And now it came to your notice that yes, this transaction has not been reported in the return. So the government is giving you an opportunity of updating your returns. You can update these returns within 24 months from the end of the relevant assessment year. Say for financial year 1920, the assessment year is 2021. So you can update your returns in assessment year 21-22 and assessment year 22-23. The provisions are applicable. Different provisions are applicable for both of them. If you file your update your return in assessment year 2021, 21-22 or 22-23, we'll learn about it later. So what is it? Updated. Any assessee may furnish an updated return of his income, of the income, or any other person in respect of which he is assessable under the Act at any time within 24 months from the end of the relevant assessment year. A person cannot update a return. That is, you will not be, this section, that is section 139(8)(a) will not be applicable. You will not be able to update your return if the return is a loss return. Your original return was a loss return, you cannot update it. Over here, if the tax liability is decreasing, if you are willing to update your return for an expenditure, you will not be able to do that. It results in the increase of refund. Some deduction was missed by you, something or some other thing where revenue is at loss. You cannot update your returns. Also, say some search has been initiated by you on your end or a person related to you whose transaction is being reflected in your return as well. You cannot update your return in case of search, survey, or any kind of notice or assessment made on your behalf or a transaction related to your file. You cannot update your return after that. In case of money laundering, you have received a notice in Money Laundering Act and then you update your returns on income tax. That will not be allowed and accepted. Such return will be considered as void. The section, you can look at your screen. An updated return has been furnished by him. Under also, if you have updated your return once, you cannot update it any further. So you cannot update after updating it once. If any proceeding of assessment or reassessment has been completed for the relevant assessment in your case, you cannot update the returns. Any prosecution proceedings under Chapter 22 have been initiated, you cannot. In nutshell, we can tell that if it is purely voluntary, it has not been initiated by your end on basis of some notice or something, any action from the government's end, you can update your return, otherwise you cannot. Now section 140B. This section has been introduced specially and it is directly related to updated return. Obviously, if you are you cannot update your returns if your tax liability is increasing, your refund is increasing. So if your liability is increasing and you are showing some other income, you are supposed to pay tax. That tax will be paid under section 140B. In this case, the tax payable will be adjusted with all your TDS that you had earlier, all your TCS, advance tax, self-assessment tax paid by you will also be considered. If there is any refund claimed by you earlier, which should not be there, you have to inform about it there too. And any fees, say 234F, if applicable, if it is firstly filed by you, say you have not filed the returns earlier, you thought it was below 2,50,000, but when you approach the consultant, he is telling that you are liable for the previous year as well. You have to file your return over there. If 234F is applicable, you have to pay that, and all the details of the challan as it is right now, that we have to enter all the tax payment and then file the return. We have to intimate about all the challans and we have to update it over there in the return and then upload it. So here it is, whatever relief you, where return of income under section, sorry, you can see clause 2, where return of income under section subsection 1 or subsection 4 or subsection 5 of section 139 has been furnished, where you have furnished it earlier. You will pay furnished. You will have to consider everything: self-assessment tax, tax deducted or collected at source, any relief or deduction claimed under section 90 or 91, that is DTAA. You have to consider all of them again. Only the updation will be your income, and the increase in tax liability should be. So now, why is this government allowing you, and how? What all will you have to bear? What will be the cost of this updated return? The first cost that we can see is if you are filing the return for the first time and after the due date 139, 1, 4 or 5, that is belated, revised or original return within due date was filed. If it is not an updated return, if it is your first return under this section 139(8)(a), what you have to do is, sorry, give me a minute. Yeah, if it is the first time, you will have to be pay 234A obviously for the delay of return filing, 234B for the extended period, and 234C, which will obviously be the same as it would have been earlier. It won't change. So yeah, 234C will stop obviously. 234B and A will continue. You have to bear that cost. 234F, if it is your first return, if you have not filed your original return, the late fee has to be paid. And what else? And there, the government has come up with an additional income tax for updated returns. That is, if after the end of relevant assessment year, you file your updated return within 12 months, you have to pay an additional income tax of 25%. You can see in point 1 of clause 3, 25% of aggregate of tax and interest payable if such return is furnished after the expiry of the time available under subsection 4 or subsection 5 of section 139. That is, after the end of relevant assessment year, if you file within 12 months, you have to pay 25% of additional tax liability. And if you file after 12 months but before 24 months, you have to bear an additional cost of income tax, that is 50% of the aggregate tax payable. So now there is to prevent excessive litigation on a particular matter from the department's end, the government has come up with this new section 158 AB. It says that if a question of law, not a question of fact, question of law is pending in Supreme Court or a jurisdictional high court from the department's end. Say the order was passed in the favor of assessee and the department feels aggrieved and it wants to appeal. The Supreme Court, that is the collegium, may decide to inform the department that further appeal should not be filed right now with the High Court or Supreme Court, as there is a case pending already on it. So it will be a great thing for the involvement of cost in appeals and under Supreme Court and High Court is quite high. Also, the harassment for the public is being saved here. It's a good move by the government. Section 194 IA has been amended by the government here. Section 194A deals with TDS on sale of property. The section here has been amended in a very simple way. Earlier, it was 1% of the such sum, that is, whatever your transaction value, you are supposed to deduct TDS on that amount. But here, government has played a good move, and it says that you have to deduct TDS on stamp duty valuation. So automatically you will have to transact and this according to the stamp valuation, as the 26 years will reflect it. Section 194R has come into picture. This deals with any benefit or purpose that a business house is giving to an agent. Yes, we give commission to the agent on which TDS is deducted under section 194H if the amount exceeds 15,000 and the TDS rate is 5%. But in case if you are paying or giving any benefit to that agent that is not chargeable as commission or not deductible under section 194H, you are required to deduct TDS under section 194R. Well, now what is the limit over here? As a section for section 194H, it was 15,000. Here the amount is 20,000 rupees. Yeah. So commission is separate. If you give any perquisite or benefit of more than 20,000 rupees to an agent, you are supposed to deduct TDS at the rate of 10% on such amount. Also, it can be in cash or in kind. If it's in kind, fully in kind, then you have to collect that TDS from your agent and deposit it to the government only. Then you can give him that benefit, as it is in the case of lottery currently. Now, I think we have covered the major amendments in income tax, and let's now move to GST. What I feel is the major amendment here that government has made in GST is, we all know that any mistake relating to the previous financial year can be rectified, or any input that was left behind that was unclaimed or unavailed by you could be claimed by due date for the return of September. That is, 20th October generally for monthly return filers. So if you are claiming any input or if you are declaring any liability with respect to previous financial year after 20th October, it was not legal, or input, it was you that input, if you are claiming some input, that input was ineligible. The that date of 20th October or due date for the return of September has now been changed and made it to 30th November. So any return filed after 30th November, if you are claiming any input of a financial year, say if we let's take an example of financial year 2021. If there's an input of X amount that you have not claimed in financial year 2021 returns, you can claim it up to 30th November of the succeeding financial year, that is 30th November 2021. If you are claiming any input pertaining to financial year 2021 after 30th November 2021, that input shall be considered as ineligible. Debit notes in the same way, we as we know that the last date to raise any debit note or credit note pertaining to previous year's transaction was 30th September, was due date for the month of September. The same has now been made as 30th November. This is giving us time. Obviously, we are thankful to the government for that. Cancellation was a big matter. Cancellation year, earlier it was supposed to be for composite, that is people registered under section 10. It was supposed to be that if you are not paying for any 3 tax periods, your registration was liable to cancellation. And for regular taxpayers, it was for 6 months. If you are not filing your returns, uh, if you are not filing your returns for 6 months, your registration was liable to cancellation suo moto from the department side. We Government has made a small change here. Now it's not the three continuous tax periods for composite. It's after the financial year. If you do not file any of your returns for 3 months, you are liable. Your registration, composite registration, is liable for cancellation from the department's end. And in case of regular taxpayers, the government has removed any specific timeline. The government has now added the words as may be prescribed. You can see in section in point 100, point B, in clause C, for the words a continuous period of 6 months. Earlier, 6 months, you do not file the return, you are liable for a notice. You can get a notice any day, and your registration is liable to cancellation. Now it is such continuous tax period as may be prescribed. So we have to wait for the prescription from the government, what it prescribes, what the CBIC tells. It may give us staggered thing that for so and so turnover, these many months, if your aggregate turnover last year was 100 CR, these you if you do not file your returns for 3 months, your registration is liable to cancellation. For less than, it may be so. We cannot say anything right now. Just wait. And that's it for GST. Also, we do not find any more amendments, major amendments, I would say. There are many amendments, small amendments.
So from here, I take it from Viraj. So I hope we could add some value to you people in understand the amendments that have been brought by the Honorable Finance Minister. And we'll close our video here. And if there is any doubt, I will be happy to reply in the comments. I think Viraj would like to say something.
Do like, subscribe to our channel and help us grow.
Thank you.